All right, welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. We'll wait just a couple of minutes to get started here, give everybody a chance to jump on, give us some time to go live on all of the different platforms, and then we will get into it. Got a great topic today, which is one of the things that we specialize in, so definitely looking forward to that. We put up the chat, so you can feel free to go ahead and drop a comment as you tune in. Some people already dropping comments. Good morning, Mark. Good morning, Adam. Everybody tuning in. We will get started in just a few seconds. Hope everyone's been having a great week so far. Good morning, Matthew. Everybody dropping comments there in the chat. April, Christina, Ben, good morning, everyone. Good morning, good morning. Hello, Geneva tuning in. All the Mortgage Calculator team tuning in. All right, looks like we are live on all the different platforms, so we can go ahead and get started. We'll take off the chat and we will go ahead and get into it. Welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. We do this show every weekday to go through the different live rates of different programs, and then we do a deep dive into a different topic every day. Today's topic is going to be something that we're very familiar with here at the Mortgage Calculator, which are 5 to 8 unit properties. So we'll have Jose do a deep dive into that here in a little bit. But before we do that, just like we do every morning, we're going to go ahead and pull up the rates for some different programs and see the actual live rates for today. So Nick, why don't we go ahead and pull up our pricing tool and see what the market is looking like today? Probably a very interesting day today.
Yes, hopefully we see some downward movement. Let me go ahead and switch my screen and we'll get started. All right. This is our pricing tool for our team of mortgage professionals. As Kyle stated, if you'd like a full loan estimate with a full breakdown of all the costs, please get with our team members. We have over 300 licensed loan officers in 22 states for primary and second homes, and we can do our business purpose, DSCR, which is the topic for today, our 5 to 8 unit properties, right? Commercial properties. We can do those in 44 states as well. So today we're going to use the pricing tool to check out the general rates and APRs for our general programs. It is May 4th, just after 11 a.m. So all our general programs have new rates, and there was just a Fed meeting yesterday. So a lot of movement has happened since our last meeting. So let's get into our demo today. We're going to set up a nice, easy loan amount, nice, easy scenario, $400,000. We'll set up the LTV to 80% loan to value, 20% down payment. We'll set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost, which is our typical request. Most customers ask to buy it down a little bit. And we're going to compare our programs, first conforming conventional, then we'll check out our FHA, and then we'll go into expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs with alternative income documentation. We do have VA available as well, but that's only for our eligible veterans. So if you are a veteran, please get with our team member. We'd be happy to quote it, but not everybody's eligible vet out there, so we don't do that live. And same with USDA, that's only for properties in a rural eligible area. So if you do happen to be shopping in a rural area, please let us know. We'll be happy to quote that for you, but not everybody is. So let's start today with our conforming conventional. We'll set everything to a purchase, 30-year fixed standard loan, primary occupancy, single family home, 1 unit, state of Florida, county Miami-Dade. And for all of our demos today, we use an estimated FICO of 760 and an estimated debt to income ratio of 40. So let's check out our rates this morning. So definitely a little bit of downward momentum. Hopefully we see some more. Looks like the best option this morning, 6.375 for one discount point in cost and a final APR of 6.551. Now, if a customer doesn't qualify for conventional for any reason, many times the next best option that we would want to quote is an FHA. FHA programs have a little more leniency on credit as well as a higher debt to income ratio we can use. So we can simply set up the same scenario and switch it to FHA, keep everything else the same, and we can compare our APRs across the different programs. So let's check out what FHA is doing this morning. About the same as yesterday, not as much movement as we might have thought after a big announcement. Looks like the best option here. Yep, there's a little better option at the bottom. 5.625 rate for 0.875 discount points and a final APR of 6.223. A little bit less in this case than the conventional. So again, with the recent changes to FHA, even though there is mortgage insurance upfront and yearly, they did change those amounts, and it is actually, in this case, a slight bit cheaper than conventional. Now, where we really love to specialize here at the Mortgage Calculator is many other banks and lenders don't have any other loan options besides conventional and FHA. But fortunately, here we have over 5,000 additional loan programs under expanded guidelines, aka non-QM. So we'll set up our final demo for a primary home, the same setting, 80% loan to value. Everything else is the same as our other two demos. However, with non-QM, we can now select alternative income. So full doc is 2 years tax returns, which is what's required for FHA and conventional. So that's typically what most people would use for those loans. So typically we would choose a non-QM to do alternative income. So we would do 1 year alt doc, 2 year alt doc. We have asset programs, business bank statement programs. We have our DSCR programs we'll talk about in a minute. We have personal bank statements, VOE, 1099, P&L, all kinds of different versions of non-QM programs. But our most popular by far for a primary home is going to be a 12-month personal bank statement loan, and that's for our self-employed borrowers. Many times our self-employed borrowers, when they have 2 years of tax returns, have various write-offs, so they either don't qualify or don't qualify for as much income as they wish. So in this case, we're actually going to use 12 bank statements, their last 12 bank statements, and their cash positions in the bank to determine debt to income ratio using their actual cash in the bank statements rather than their tax returns. Most self-employed borrowers qualify for much more income and therefore a much higher loan amount where they would either not qualify before or not qualify for as much loan as they wish. So these are great solutions for our borrowers, especially our self-employed borrowers out there. Let's check out our bank statement rates this morning. Ooh, nice. We got one option that definitely moved. 6.875 for one discount point and cost. 6.955 APR. So great option there. Just under 7 APR to compare across the programs. Remember, the conventional was about 6.5. So very comparable here to use alternative income documentation. So we have a ton of different options here. When we use bank statements, some of these may allow things like foreclosures, bankruptcies, different variations of these programs. So there's tons of different options. Please get with our team so they can navigate you through which one of these works best for you. But as you can see, we have a ton of different options available. Now, before we pass it off to Jose for a deep dive, we always want to do the live pricing for our investors out there. So we'll do a couple demos here for investment property. Switch the occupancy to investment. We'll set the same LTV to 80% loan to value, 20% down payment. And we're simply going to compare our two options here. We can do a conventional conforming loan, obviously what everybody's used to for investment property. And then we'll compare that with our expanded guidelines, non-QM programs that we have available. Remember, FHA, VA, USDA are not eligible for investment properties, so we'll simply compare these two options. So we'll keep everything else the same as before. All we did was switch to investment property. And let's check out our investment rates this morning. So as we say every day, the GSEs, the conventional loan programs, they have added additional adjustments for investment properties. So we don't have an option with one discount point, but the computer found a good option here, 6.875 rate for 3.75 discount points and costs, and a final APR of 7.143. So most of our investors would like typically a little bit lower discount point option, but with the conventional programs and the loan level price adjustments that they've added, even if we go to a little bit higher rate, there's not a lot of lower options. Here's a good one, 7.49 rate for 2.5 discount points and costs. Final APR of 7.716. So many times our investors want other options, and that's where we love to present our non-QM options, where we can lower the discount points. So for our final demo here, we'll set it back to investment, 80% loan to value, and we'll go with our expanded guidelines, aka non-QM. And you'll notice we have a couple options we have to select now. First, our income verification. Most popular option for an investment property by far is going to be our DSCR program, debt service coverage ratio, and that's because it actually doesn't require any income or employment from the borrower. We're simply going to use the estimated rental income from the property. If that rental income can cover the PITIA of the mortgage we're looking at here, that is a ratio of 1.00 or higher. That means the rents can cover the expenses. We even have options for loans where the rents won't cover the expenses, a ratio of under 1.00, where the property doesn't quite cash flow. So tons of different options that we have. For our demo today, I will leave this blank so we can see all the different options. And finally, a prepayment penalty is standard on any of the non-QM investment property programs. So we always price it with 3 years in our demo. We can choose 0, that will cost more and limit the loan programs. And we can choose 5 years as well, which will cost a little bit less, but not as many loan programs allow 5 years. So 3 years is the most popular option. So with those settings, let's check out our DSCR rates this morning. So the top option here, great option, 7.625 for 0.85 discount points and costs, and a final APR of 7.7. So remember, when we're comparing across conventional, very similar APRs, but most importantly here, we've solved the problem of the investor having to have a lot of cash for discount points, very low discount points here. So most of our investors are happy with these options. Also with the DSCR loans, you can start multiple loans because they don't require employment or income. So cash out multiple properties to purchase multiple properties. So very flexible loans here for our investors. They love them. Tons of different options, as you can see here, for DSCR values that vary. We also have different options with different prepayment penalties that vary. So tons of different versions of these programs. Some may allow short-term rental income, things like that. So please get with our team to find which one of these will work best for you. And let me go ahead and get into our deep dive topic for today, which is actually a very specific subset of this DSCR product. So let me change my screen real quick again and introduce today's topic. So we just looked at the DSCR rates. Those are our investment property programs that are kind of a hybrid commercial program. And that is what we'll be talking about today as well for our true commercial properties. Remember, a 5 to 8 unit property is a commercial property. 1 to 4 units is still residential. Anything over 4 units, so 5 to 8 units, is technically a commercial property. But we're talking about a small commercial property here. So a 5 to 8 unit residential property, we can do this very specific subset of our DSCR loan product, which is pretty amazing. Traditionally, to do a commercial property, right, anything over 4 units would take a commercial loan. This product is not really a commercial loan. It's our hybrid DSCR, same basic DSCR that you're used to, that we talk about pretty much every day for 1 to 4 units. We can now apply that to 5 to 8 unit properties. So Jose did talk about a flavor of this program yesterday with the mixed use version, which again, a mixed use is a commercial property, right? So this is kind of the continuation from yesterday where we talked about the mixed use version. Now we're going to talk about the straight residential 5 to 8 version of this DSCR product. So if you're ready there, Jose, go ahead and take it away.
All right. Good morning, everybody. This is, as Nick was saying, very similar to product. The only difference here with this one is that this does not have the mixed use component. So what that means is that it is going to have better pricing, right? Because for the mixed use component, they are putting a loan level price adjustment of 2.5 points, which you're not going to have that issue come up with this one. So you're going to have considerably better pricing. Now, obviously, the reason that the pricing is better is because this product does not have the mixed use component. This product is for properties comprised of residential units only, right? That's very important to note, residential units only. Now, keep also in mind that there is going to be some restriction regarding minimum size of the units and the components that the units need to have. You know, they need to have like kitchen and a bathroom and, you know, full bathroom, full kitchens, stuff like that. So be mindful of the specific property parameters. But the most important thing to note is that it is for 5 to 8 units only. And also this option that we have is a hybrid type option where they are not going to be honing in on the property zip code and population densities to disqualify the property as you would have on the traditional commercial product that is going to be used for this type of property. Normally you'd go to a true commercial lender for this, for, you know, whereas we can use our DSCR option to basically underwrite this property in the same way that you're going to underwrite the 1 to 4 units. There are a couple of minor guideline differences regarding the experience of the investor, but other than that, pretty straightforward DSCR loan. One thing also to note is that the rate in this product is superior to almost every 1 to 4 unit DSCR option out there. So this is a very remarkable program for 5 to 8 units. Everyone should be taking advantage of this, both as the MLOs to be delighting your borrowers with this amazing product, and both as the borrowers so that you're not missing out on these amazingly low rates. So let me go into our examples here. Right. So in the rates I have here, I have rates from the single table grade. So you're not going to see a whole rate stack that we're seeing, that you're used to seeing, because of the limitations to be able to obtain the quotes for this product. But I tried to more or less stay in line with what we've been presenting. So here, we have the highest LTV option, which is 75% LTV, 25% down payment. And this is for the highest credit grid as well. So here we're looking at 7.875, and that is a cost with our loan amount of 562. That's under 2 points. That was a cost of about 1.75 points. So keep in mind, we can go down on this loan amount easily to a buy down of 3 points. So there's plenty of available lower rates here. Plus the borrower can choose to get a little bit higher rate if they want a little bit lower cost. But 7.875 is a really good option for this 5 to 8 unit purchase with an 800 credit score. So now we drop the credit a little bit just to give you an additional option. So this is very similar cost, 98.44 on the 800 credit option, 10,547. So it's like a quarter point higher in cost, but you will note that the interest rate is almost 1% higher. So there's about a 0.875 differential due to the lower credit score. And now we keep going down in the score. Now you will notice that if you want to stay at a 75% loan to value with a 680 credit score, it's going to cost you, right? I mean, it really is. You're looking at 11.875, and that has a cost of 2.75 on that one. So again, for the borrowers with the 680, you would probably, as you can see in this example here, probably want to consult them to go 70% loan to value. If they can afford the extra 5% down, the rate drops substantially to 8.875, and that's at a cost of 2 points. Here we have a $525,000 loan. So our 10,500 is exactly 2 points at 8.875. So you can see again, I'll compare the 75% loan to value 11.875 with a payment of 57.32 and 8.875 with a payment of 41.77. So right there, you're looking at about a almost a $1,600 swing monthly in the payment. So that 5% extra LTV that the borrower benefited from is going to be consumed very quickly with the $1,600 per month extra payment. So really not a good example unless it's absolutely the only way they can get into that property. And that is 70% LTV with a 680. So now we go 65% LTV, 35% down with the same 680. Then you see that now you're at 7.875. So now your payment really drops to $3,535. Now, it may be out of convenience for the borrower that he wants to go with a lower rate, or keep in mind you do have to meet certain minimum DSCR parameters, and for this program the minimum DSCR is 1.1, so it may not be to just set of a convenience of the lower payment, but possibly to meet the DSCR guidelines. But 7.875 with a 680 is amazing on this type of property. And now 660 credit with the 5 to 8 unit, similar, same great rates. So it seems like 660, 680 is the same grid once you take the LTV down to 65%, which is best case scenario. And now showing you a little cash out option here. We're looking at 8.125% at a 70% loan to value, which is your best available cash out option for this program. So very good options here for our 5 to 8 units. If you price out 5 to 8 units in the commercial world with a full term 30-year loan, because keep in mind a lot of times in the commercial world they may want to offer you a 5-year term or a 10-year term with either a 25 or 30-year amortization. It's very common commercial loans to be set up that way. And when they do offer you the full 30-year fully amortizing loan for this type of property, typically in the commercial world, their rates are going to be in the 10s, mid to upper 10% to give you a fully amortizing 30-year loan on this type of product, assuming that you meet the zip code population density requirements, right? Now, rural designation on the appraisal is totally different. If your property does get rural designation on the appraisal, it's going to be very tough to dig out of that hole with the DSCR properties. So keep an eye out for rural and keep an eye out on how you can work around that.
All right. Definitely a great product there. Also, as you know, something to mention there, Jose, is that this can give your borrowers or any investors out there watching a huge advantage over getting these type of properties, because these type of properties are traditionally hard to finance. And if they can finance them, as you said, they have to look at the zip code in a traditional commercial financing. Well, if none of the traditional commercial outlets like the zip code, obviously coming in with this program gives you an advantage over any other investors, allowing you to get the property or get the property for even cheaper, right?
Absolutely. The only thing keeping from more of this program being originated is simply, like you just mentioned, a lack of awareness by the investor that the options are available, because pretty much every investor that we come into contact with that we go over this program, if they qualify, if the holdback is not based on their credit or their assets to close, it's usually results in an application, because after they've shopped it around all over the loan world, and then all of a sudden they come and we're giving them 7.875 with 1.5 points, the search just ended right there, and they are ready, they're fully committed to the application.
Absolutely. So you see, it definitely takes a loan officer consultant to walk through these different programs. So all the loan officers out there, make sure to familiarize yourself with these products and the points like I just went over, right? To talk to your clients about. If you are an investor or a borrower out there, definitely something to take advantage of. You can go ahead and apply at themortgagecalculator.com, and we will pair you up with one of our loan officer consultants. We have over 300 loan officers licensed in 22 states for primary and secondary homes, and we can do these type of loans, business purpose DSCR loans, in 44 different states. So themortgagecalculator.com is where you can apply, or you can email us info@themortgagecalculator.com, and we can go ahead and pair you up with one of our loan officer consultants. It looks like we got 2 questions here, Nick, if you want to pull up any questions before we get out of here.
Jason asking, is it a true commercial? Does it get reported on their personal credit?
It is not a true commercial product in the sense of, commercial. That's why they don't have to abide by those commercial requirements like checking the zip code for population density. And in regards to getting reported on the borrower's personal credit report, it is not a non-recourse loan, which are the only loans that we can guarantee will not affect the borrower's personal DTI.
And it is a personal guarantee, so there is recourse, right? Non-recourse would be a true commercial. So yes, this is recourse. This is personal guarantee. Hybrid product here.
Well, also too, Jose, you touched on the fact of commercial and the population density, but it's much more than that, right? When you're doing a traditional commercial loan, it's not just population density. So you can't just say, "Oh, I'm in a big city, it should work." We're talking about crime rate. We're talking about a lot of different factors, right? Which is just a huge plethora of things that a true commercial deal is going to have to pass at a lender, correct?
Correct. Yeah. On the residential side, that would be considered discrimination. That we'd be talking redlining, which is a really big problem when you single out a neighborhood and say, no, there's too much of this or too much of that, I'm not gonna lend there. That's not allowed in residential lending at all. That's like a big no-no. So yeah, totally. A lot of different points like you just mentioned that do not have to get taken into consideration because of the greater responsibilities, I guess, that's put on residential lenders to ensure that they're reaching out to the communities in which they're doing business to give every possible opportunity within their guidelines to lend.
Absolutely. All right. I think we are good then. So thank you everybody for tuning in. We do this show 11 a.m. Eastern every day every weekday, where we go and check out the different rates, and we do a deep dive like we did today with the 5 to 8 unit properties. So definitely tune in 11 a.m. Eastern time every weekday morning. Thank you, Nick. Thank you, Jose. Thank you everyone for tuning in, and we hope to see you tomorrow for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.